A very good afternoon. You're watching the newsroom right here on ET Now. Look at the markets. The same story is unfolding today as well. Today, benchmarks are also coming back after 3 days of flat closing. Of course, the broader markets were already active and they are active today as well. One is getting a sense that the 3-day consolidation, after that, the market is active once again. Earnings flow are also playing their own part. Access was interesting, even after slippages rising. The NIM picture was very good. LNT too, weak Q3, but guidance was very good. So almost 46-47% of Nifty weight earnings are out now. And up till now, in line to slightly better is what the sense we are getting. But Manish Jain is here from Ambit. Manish, good afternoon. Hi. Thanks for stopping by. What's your verdict on the numbers which have come so far? The commentary which you may have picked up of the top managements. What are you making of it?
No, I think definitely when you look at the broader markets and when you look at the numbers that have come out broadly from the private sector banks, some of these construction names like L&T and then IT, I think broadly I'm in agreement with the view that you just said, which is that I think the worst seems to be over from here onwards. Things are looking like they are kind of stabilizing right now, and we are probably 1, maybe 2 more quarters away when the growth starts picking up. And this is in sync with my view on the economy as well, where I think the worst is probably behind us. So it's kind of, I think, pseudo mirroring that. And then not to mention that, from the unlisted side also, when you look at the commentary that is emerging from the retail side, for example, right, the numbers have actually been fantastic. The festive season has been probably the best that we've seen in the last 4 or 5 years. Pretty much across all discretionary categories, we've seen double-digit growth coming through. So yeah, I'm optimistic.
Manish, also talk to us about, the news flow right now is the highest around the telecom space. And what is most interesting is that, almost a $3.5 billion fundraise by Bharti got $10 billion response. We already know that there's a sword hanging on most of the companies on AGR dues. But Bharti, for example, is at lifetime highs, 5% away. The Jio part of Reliance also did very well. So clearly, the sector's health is improving if you talk about just 2 players. What's your own sense? Do you think the worst for survivors actually may be coming to an end?
So if you look at it, telecom has been one very, very interesting space in India for the last almost 20 years now. If you think about the number of players with which we started off the whole space with and how many people are left in the fray today, almost the double-digit number has kind of fallen off the wayside, and that's typically how it is in emerging categories. Do I believe that we are heading towards a duopoly kind of a situation? Eventually, I do think so, yes. Irrespective of what happens with the AGR dues or not, whether they get deferred, whether they do not get deferred, irrespective of that, my own personal view is that it's going to be a very uphill battle. It's going to be a very steep climb for the number 3 player. And hence, essentially, it is going to be a 2-horse race. And with that perspective in mind, with a 2-year view, are things looking to improve here onwards? Yes. One price hike has already happened. Another one...
April to June DOT is indicating probably another COI one. Is indicating that probably another one.
Another one. And then not too far away before, we see a price hike happening on the post-pay side as well, yes. Right? So I think definitely given the fundraising that has happened, given the fact that, we are looking at price hikes coming through, I think telecom space does look like it's something that I would be optimistic about, and I would be bullish on from the next 1 2 years
Manish, stay with me. My colleague Nentara is also here with latest on the matter of AGR and the telecom space. Nentara, tell us what exclusive details are you gathering right now?
TikTok, today is supposed to be the deadline for the telecom companies to actually pay up the adjusted gross revenues. You're talking about more than 90,000 crore rupees, and ET now exclusively reported at 8 p.m. yesterday that none of the telecom companies were going to be paying up. Vodafone Idea writing to the government saying it wants to wait for the next week's Supreme Court hearing on the matter. On the timeline, it's prudent to wait. Also cited the self-assessment it has not carried out. Remember, all the companies have to do a self-assessment of sorts on how much of the dues are actually have to be paid. So Vodafone Idea not finishing that. Today morning, we reported that Bharti Airtel has submitted a similar letter to the government saying it's best to wait for the next week's hearing. It has every intention of complying with the Supreme Court verdict. Tata had also shot up a similar letter. But remember, it's Vodafone idea that the markets were watching out for so closely. Remember the way the stock tanked? I'm sure if we can show you the 10-day intraday chart, you can have a look at how the reaction came, coinciding with the Supreme Court dismissing the review petitions. But guess what? There is silence from the government. Ravi Shankar Prasad, the telecom minister, was in Srinagar yesterday along with his telecom secretary. Till today, the government has not responded. January 26th is almost here, which means that central Delhi is also pretty much in a lockdown mode because of the Republic Day parade practice and the DOT is not open for business. So all I can say is that the deadline is looming large. We don't know how the government is going to be responding to all of these letters that the companies have written. Will it send a show cause notice? Is it going to agree that yes, let's wait for the next Supreme Court hearing? The ball is now in the government's court.
Right. Thanks very much for that, Nentara. In fact, our guest Manish was also talking about the factors because of which the space is looking very attractive right now, the fundamental shift in the overall factors in the space. But shifting focus, we have Asian Paints number which came in yesterday. Let's also try and get in the management bite which is there in the con call. But before that, let's discuss that number with Manish. Manish, not a call on the stock, but I want to understand, because you look at that name very closely.
I do.
About the kind of numbers they have managed to give out in this environment.
See, the key takeaway for me from the whole thing was that they have managed to deliver double-digit growth again, right? So this is phenomenal given the fact that paint sector in general, or the home improvement sector in general, typically tends to have a very strong correlation with the overall GDP growth rate. And the kind of slowdown that we've seen from the peak has been massive, right? 8.5% coming down to 4.5%, and still not, the worst probably being over. Q3 numbers are probably going to be lower than that. And the fact that monsoons were extended, this is typically not the peak season, and you're coming off a very, very huge base, right, of 15-16% volume growth. On top of that, if you're still able to deliver low double-digit volume growth, I think it's fantastic, right? It just shows the vision that the management has in terms of trying to create newer markets, newer categories, getting into unconventional segments like wall preparation, getting into unconventional segments like waterproofing, and being able to deliver that growth relentlessly quarter after quarter. I think it's a superb set of numbers.
Right. In fact, yeah, he is right about saying that they are going deeper in tier 3, tier 4 markets, new products like adhesives and solvents, etc. So innovation is clearly at the heart of the management strategy. Let's hear out Mr. Anand, who's the chairman and managing director of Asian Paints, and how the quarter actually fared for them.
We continue to be affected by adverse macroeconomic conditions in the domestic economy, as well as certain adverse impact of an extended monsoon till almost October end, early November. Demand conditions have been a little weak, and in an economy with a large domestic consumption sector, this is getting reflected in the lower GDP growth rates that have been published. We would continue to monitor and respond adequately to the evolving demand conditions. On the cost side, there has been some increased volatility in a few key raw materials. We will need to watch out for any sustained movement on the raw material cost front. In the international markets, we will have to be careful about the emerging situation in the Middle East, as well as business conditions in key markets like Sri Lanka and Bangladesh.
Let's shift focus and put the spotlight on banks. Let's hear out what Axis Bank management had to say, and then we'll get in my colleague Varun also, who's done some work on the private sector banks numbers which have come so far, before I get in Manish's view on the stocks. Let's get Axis Bank's commentary first.
Our non-fund-based exposure to BB has has increased by about 1,300-400 odd crores. Almost all of it is driven by a large telecom exposure, which we have during the course of the quarter downgraded to BB. And so our outlook is reflected in that. The ratings have been downgraded. The account continues to be performing right now. We continue to be in conversations with the client, but yes, clearly the economic environment has deteriorated, or the operating environment has deteriorated for the client, and that's reflected in our rating.
We're also beginning to now see tariffs going up. We are seeing some sort of consolidation that's happening in the marketplace as well. We continue to have active conversations in some of the relationships that we have within this group.
Right.
sector this Q3, the first one being growth week across the board. So whether you were HDFC, Kotak, Indus and Axis, all of you have seen tapered growth down, and the smaller players should follow suit. Moving forward, the next big thing we're going to be examining are the slippages and the stressed pool addition. So there's been a mass uptick here. HDFC 53 billion, Axis 51 billion, Kotak Mahindra 10 billion and IndusInd 20 billion. So across the board, you're seeing slippages really rise up for all the players who were supposed to be absent of asset quality concerns. The watch lists are also expanding, as are the delinquencies. Third, the downgraded corporates may not normalize. So the corporate, which has been the pain point for a lot of these banks, more of them keep getting downgraded into the watch list. Recoveries are muted and actually falling on a QOQ basis, and you're not really seeing that trend pick up the way it was supposed to this quarter either. Moving forward, the next thing we're going to look at is the retail and SME segment. Now, what's happening is this segment has traditionally been absent of NPAs. Now, you're seeing an uptick in NPAs here as well, and predominantly in the self-employed space. So self-employed versus salaried. It's a huge debate over here, and salary tends to perform much better than the self-employed as far as retail goes. Finally, we're going to look at the MFI segment and all the concerns there. Assam, Karnataka, some of these MFI companies might not be paid back. NCR is now being flagged off as a potential threat, although no concrete developments there. So, you know, it's just a sign that these MFI companies may have some NPAs to write off unless there's a critical resolution reached there as well. And all this will continue to determine the outlook going forward for all these private banks.
Right. So, Manish, there was my colleague talk about how some of the private banks are showing some slippage worries. Last 1 year, the scene on the financials belonged to corporate banks. ICICI and Axis both did very well. And of course, historically, retail-centric have done very well. So now the opinion is getting divided whether continue with the consensus of corporate private bank. And on the other hand, retail private banks are showing some chinks on slippages front. You're also looking at adding some names in your funds. What are your thoughts on this entire issue?
So, you know, again, like you said, retail banks, retail-focused banks, private sector banks are something that we are incrementally starting to get a little more bullish about. But the fact is that if you look at the whole financial space, it has been almost a 3-year, 4-year kind of a journey. Started off with the whole NBFC crisis, and then we moved on, you know, to corporate loan book stress coming through, and now people are starting to talk about the crisis as far as the retail loan book is concerned. And that typically tends to be a cycle, right? Retail delinquencies are typically the last leg of the cycle. Now, but having said that, when you look at the most of the good quality names, right, when you look at City Union Bank, when you look at HDFC Bank, most of these guys had already cautioned out at least a couple of quarters back that they are going to be a little more careful in terms of provisioning. It is going to be a little accelerated. They are going to be a little more careful as far as loan growth is concerned. They are going to cut it back. And we have seen that playing out in the numbers for 2 or 3 quarters now. So in that sense, I wouldn't be too worried. I would still incrementally be between PSU banks and private sector banks. I would still be more bullish on private sector banks. And as far as corporate is concerned, I think corporate loan book will take a little while, you know, to pick up. It is going to be more of a phase of stabilization for the next 2-3 quarters before it really starts taking off in a big way. So I'd still keep going with the private sector banks, which are more quality, which are more retail focused, and I would still keep, you know, betting over there in that space.
Right. Let's also get a view coming in from L&T. It's the industry leader in terms of capital goods and engineering, and despite of slightly weakish third quarter, they have maintained their FY20 order inflow guidance and have stood their stance. Let's get a view coming in from the management, and then we'll discuss it with Manish.
Expansion of the direct benefit transfer by moving a few more subsidies into direct benefit transfer, and strengthening insurance, I think, is going to be still critical in terms of there is interesting, in addition to refining the current Prime Minister Fasal Bima Yojana, there are interesting options there as well in integrating the big data and the digital mechanisms to transfer the risk management and mitigation to individual farms as opposed to larger aggregates. There are interesting startups which are now in the process of doing that as well. So I think how do you put some of the money into venture capital equivalent for these startups and mobilizing that. And the third piece is in terms of farm produce organizations, FPOs, as one important mechanisms to create shared assets, build capacity of the farmers, and ensure that the knowledge transfer also occurs to the farmers. So I think these are the kind of spreads that one would really wish that the budget puts in.
The order book consequently has grown by 9%. Revenue is up at 6%. EBITDA is up by 10%. That's good news because as we deal with little softish revenue, we have dealt with more profitable revenues. So the margins are up by 10% and the profit after tax is up by 15%. And these are quarterly numbers compared to the Q3 of the previous year.
In the 9 months, I think we have managed a growth, and that includes the infrastructure business. The orders are there, but they're taking slightly more time to settle than what they normally would. The working capital is showing a slight pressure, but I believe with the situation getting cleared, it will come down to what we have anticipated or what we thought it ought to be.
Great. So Manish, you heard the kind of numbers L&T posted and their guidance, and L&T guidance is more sought after from the entire industry per se as a handle on the real economy. What are your thoughts?
So, the most optimistic thing for me was the fact that, like you said, despite the numbers not really being great in this quarter, and we've seen pretty much across the board, all brokerage houses have cut estimates, they've cut target prices, right, pretty much. But the fact that everybody continues to incrementally remain bullish on it, the guidance has remained intact for FY20. They are looking at things accelerating going forward, and like you said, it's a barometer to judge the health of not only just the overall infra space in India, but the overall economy. And if they are incrementally getting bullish, I think that is something to get excited about. So the key takeaway from the whole L&T result for me was the fact that the order book guidance kind of continues to remain intact for FY20 despite them missing out in the third quarter. This basically says to me the fact that quarter on quarter you're looking at things accelerating significantly in the fourth quarter, and that's something that I'm going to continue to look forward to.
Mm-hmm. Let's also get in a view coming in from Morgan Stanley, another institutional brokerage, on the overall estimates from the budget. From Pankaj, and then we'll discuss how the market setup is looking ahead of the budget this time. Pankaj?
As part of this series, we have divided this into two parts. One, what the strategist is saying about the markets, market expectation, and one, of course, is what essentially, the economist is saying. So let's first start with Rhythm Desai strategist view. Budget's market impact on a secular basis has declined over the years, which means that the way market used to react earlier, it may not react earlier, or it has been declining. But still, it's very important because investors needs to focus and negate any volatility that comes in because of budget and the decisions that may come out over there. This budget, one key thing to eye out for is the scale of privatization. One may say that divestment targets may be the thing, but what they say about privatization, the scale at which they are going to do it is something which essentially the street will completely look for. So that's something to watch out for according to them. A few factors at play according to Rhythm Desai. Government spending, I think you all were talking about infrastructure. So government spending on infrastructure and rural is one of the key things that they at Morgan Stanley will be eyeing out for. A credible fiscal target. Realignment of direct taxes is also something which they are looking at. This may include, a lot of personal taxes as well is what essentially the report talks about, and that's essentially what they would be looking at. Now, when we come down and we look at what essentially Chetanaya, which of course tracks the macro, would be looking at. So they see a narrowing fiscal deficit to about 3.5, but this is for FY21. They have not given a 20 number in their report, but I think that they would also be expecting a slip. A focus on quick revenue via strategic investments. So how focused is the government on that front is something is what he would be eyeing out for as far as macros are concerned. Fundraising offer, fiscal flexibility for growth is something which they believe should be a part of the speech or should be a part of the focus of the budget. Overall, poor tax revenue collections, divestment, targets is what essentially they would eye out for. So the focus will be, according to Chetanaya, on fiscal as well as what's really happening as far as, the entire space of how fundraising will be done to meet those fiscal targets.
Thanks very much for that, Pankaj. So, Manish, last question to you would be, the way we are approaching budget this time around, the setup of the market, it's kind of on the bullish side. What kind of risk reward are we going into the budget with on the market part? Because expectations are also running high that some relief on taxation, etc., would be coming, or personal income tax boost will coming. What if the market is not pleased with the announcements?
See, That is one aspect to it, which is very fair, is that there is in general always typically an expectation that is there from the budget. But however, this time something different that I have noticed is that the noise starts much earlier and it's much louder in terms of the expectations generally that you have from the budget. Now this time around I have not seen anything of that sort, right? Hardly anybody has written anything in terms of any big expectation that they have from the budget. I think in general the mood typically right now is that of an acceptance that things are bad economically, things are bad, people are not expecting too much from the budget either, and that's a very good sign, right? Because that essentially to me tells me that it's kind of, when an overall consensus starts building up like this, it typically is the end of the cycle, right? So my view here typically is that people are not expecting way too much, right? They will have to obviously pull out a couple of rabbits from the hat to turn things around, given the fact that you're running short on expenditure side and you're running short on both revenue side, right? But the fact that at 4 to 4.5% levels from a GDP growth perspective, we are kind of bottomed out. Inflation is not going to sustain at 7% is what my personal view is. And if you are able to put together a couple of things in terms of, disinvestment or acceleration in tax revenues, or do something on the rural economy side, maybe do a personal income tax rate cut, something, even one or two things, I think they're going to be taken very kindly. The fact that despite all the earnings downgrade that you've seen over the last 3 quarters, the fact that market is holding up for such a long time kind of tells you something, right? The fact that the views are disaligned a little bit over here at the moment, but I think the market will prevail.
Right. All right, Manish, we'll let you go on that one. Thanks so much for dropping by today. Thank you very much for your time.